Hello, YouTube. The second and third biggest stocks in the S&P have now reported. Microsoft is pretty happy. It's up by about 4%, but we got a sad stock here. It's Google. It's down by about 5%. So what exactly happened and what does it mean? Microsoft pops 27% as Azure growth accelerates. That is their cloud computing business. They also beat on top and bottom line, which means revenue got a beat, earnings got a beat. Actually, a pretty nice beat. Looking here to Alphabet. Alphabet reports 11% revenue increase as growth returns to double digits. What's happening? Sorry. Well, they beat on EPS, they beat on revenue, but the headline that's hurting Google is this. Alphabet Cloud unit reports sales missing estimates. Shares fall. Let's read the one here from Bloomberg for Microsoft. Microsoft sales top estimates as cloud computing growth recovers. So cloud computing or cloud unit misses, and then Microsoft cloud computing beats. What does that mean? It means Microsoft pretty much is eating Google's lunch. So Microsoft up by 4.5, Google down by 5. And we noticed that Amazon is actually up by about 1.3 in after hours. We also got a beat from Visa, and we even had Snapchat come out. And Snapchat was up pretty strong last time I checked. Let's see what's happening now. Only about 3%, but hey, this stock has been a turd on almost every earnings. And what they told us is that ads are back. People are buying ads. So what I'm interested in looking at now is the net effect from these moves in after hours, because it's really a whole bunch of nothing. So here we're looking at ES, or the E-mini futures for the S&P 500, and we can note that we are pretty much back to where we opened. We can look to NQ or the NASDAQ, and we can see that we're down by about 9 points. So what does this mean? It means that not a whole lot has happened after the close. But if we look here to the S&P on a day like today, being up by 0.8, basically 0.8%, and trying to save our uptrend here, or the yellow line. It's yellow because there's caution. If we don't hold on to that uptrend, whoa, I feel a lot more scared. But looking here to QQQ, actually looks a lot better. Back above a key area that I was looking at roughly 358. And the NASDAQ's up by nearly 1%. So I would say that flat after hours, after a 1% move, is pretty bullish, at least for me. So let's go through the rest of these headlines here, because there's actually more to the story. So Microsoft beat, Alphabet missed. I want to mention that Microsoft usually gives guidance on the conference call, which means that this thing could be down by the time I finish recording and upload, or by tomorrow. It could also be up. It could also be up more. They're going to provide their guidance on the conference call like they normally do. Another thing that came out overnight was that China to choose fiscal muscle over reforms to revive economy. What does that mean? Hey, let's take our hands out. Time for some stimulus, right? Time for some stimmies. Let's go. And then we saw Bitcoin hit $35,000 for the first time since 2022 on ETF optimism. What's happening? Every time you hear a rumor, high, higher high. So we rocketed to 30,000 on the last one from BlackRock, and now we hit 35K. So it looks like we're getting a little bit of risk on appetite, and people are buying it up. When I look at the Bitcoin move, I mentioned this on the stream on Friday and on Monday. We're up by 32% off the 50 moving average. And what do we have? Hollow candles over previous highs with nice volume. Classic bullish. And I mentioned one more thing on Bitcoin, because I think this is really important if we're thinking about a longer term cycle here. Look at the 50 moving average at 27,000. What did we do? It was a launch pad. We rocketed over it. If we look at Ether, exact same thing. Launching off that blue line, which is going to be at about 15,092. And we're starting to make a move. Ether needs to get above about 2,100 to reclaim where BTC is right now. But this looks constructive, right? China's printing, right? Bitcoin's going up, tech stocks are up. The seasonality going to be coming into play. Before we go further, I'm going to ask you for a huge, huge favor. If you could please consider smashing the thumbs up and subscribing to the channel, I would greatly appreciate that. And I will thank you ahead of time. Thank you for your support. As we've talked about the seasonality chart, what I mentioned is that we cannot afford to mess around now. We have to go up and then up more and then up even more. So what I'm noticing here, if we go to back to our daily chart, let's go here to let's go to SPX. I think I actually have it on here. Here we go. So if I have a look right here, so we can see those cuts, then we're going to put in a line chart. Even though the market's up by roughly 0.8 today, we can know we barely even see this move here on the seasonality chart. We're looking right here, and we barely even see that it's going up. So what do we need to do? I've mentioned this before. Right here, you can see the blue line, or our 50-day moving average. We need to make it to the 50-day moving average, and then we got to get over. Why? because if we're going to form a higher high versus this dead cat bounce that we got, let me actually choose a different color here. It's a little bit easier, a little bit hard to see. Let me choose black, and then I'll go back over to here. Here we go. So we're trying to go higher right here. What we're going to have to do, so we bounced off the 200. We're going to have to make it to the 50, maybe reject, and then claim it. This would align with roughly November 2nd, which is when we have Apple, but we also have the Fed. So we got two really big catalysts coming out next week on the 2nd. And the reason why this is important is because if the seasonality chart is going to play out, we should form some kind of W, which means we have to take out this relative high right here, the local high, relative high, the dead cat bounce high, and we have to get over our 50-day moving average. So if we understand all that, this is where we need to get to start to validate the pattern. But then we also have to make a higher high over where we were in September to know that we're actually going to be going to an end of year rally where we close at the high. Look, if we look out to the rest of the year, we should be closing up a whole bunch higher. Whoa, yeah, a whole bunch higher, please and thank you. That would be fantastic. Moving here back to our hollow candlesticks, we can note that we're trying to defend the uptrend right now, and we're back above the 200-day moving average. So we got 2 daily candle closes below. Was this a trap? Hey, please make sure to drop me a comment. I always appreciate all of the comments, and I'm sure you guys are going to have some opinions this week. So what's happening here? Are we going to be going up or down? Well, we clearly have a lot of work to do. We just talked about the 50-day moving average, which means we got to make it to 437 to reclaim that high. But I also mentioned we have to get back above the September high. So what does that mean? Well, it means we got a lot of work to do. That's what the Bulls got to do. They got to start pumping, baby. Got to get stonks back. It's been stinks for the last couple of months. So failed breakdown is a nice start back above 423. Then we have to reclaim 433. But really, we have to make it all the way up to the September high. We got to get to 454. We got to rally up by 30 points. Whoa, 30 points. Yeah, 30 points. We better start bumping, baby. We got to start going. That would be about 7% from where we are right now. That would be pretty nice. I'd be looking for even more, though, going into the end of the year. Like I mentioned, we're not out of the woods yet, but things are looking cautiously optimistic. So if we now have a look here at the 50 moving average on the weekly, we tagged it and we bounced. So I see that same pattern we've been talking about extensively over and over. What do we have again here? We got a failed breakdown. A failed breakdown is a bottoming pattern like we had over here. The expansion signal is when we actually get a hollow candle closing over the previous high, like we did on this week. And then we got a false breakout, and then completely bear engulfed. Man, we got to get to work. We got to start rallying. So I'd be looking for the same thing here that we had previously. We got the hollow candle. We got the gap down pump up. We got the we got the fail breakdown. But now we got to make a higher high. And the higher high would have to happen next week. It's not going to be this week. So I'm watching closely. I don't want to get too ahead of myself, but I'm cautiously optimistic here. I think we got pretty close to 41350. That would be a correction territory or 10% off the highs. And if we fail next week, that's the target that I'm talking about. All right. So we've talked about a lot of different stocks. Let's go and have a look here at QQQ to see what the technicals tell us on the one-day chart, because we actually got that expansion signal here. So if we have a look, we got the fail breakdown on the one-day chart. We closed above it. And what's yesterday's high? 35926. We closed at 35913. So pretty close, but not quite there. And we're down a little bit in after hours now. So we can note that from that area we talked about, let's just check in one more time because this is live, right? We haven't seen anything happen yet. So ES, that's probably an inverted hammer. We're right back to where we opened roughly. And NQ is down by about 16 points. So we're a little bit right in after hours. Let's wait and see what happens. All right, so if seasonality is back in play, it should only be up from here. And the bears are going to really regret that if we just keep going up. I would also note that we saw an increase of 23% in fear and greed, going from 26 yesterday to 32 today. That's a pretty meaningful bump. So I'm paying attention to what the chart is telling me. And we can also note that other thing we talked about in terms of positioning. So this is sentiment. In terms of positioning, we're seeing the least amount of shorts going all the way back to the big short being initiated in June. They haven't been they've not been this less short, meaning basically pretty close to net long. So I made the joke about they go short, double down, go net long. We go back in time, short, double down, go net long. So short, double down, go net long. Short, double down, go net long. Short, double down, are they about to go net long? That would add even more buying pressure to the upside. Less than 65,000 contract short is pretty bullish. All right. So now what I want to do is actually just have a look here at these weekly charts, because I noticed the channel as I was flipping between different tickers, and we're clearly pointing down. That's what a descending channel means. So you can see if we put arrows here, we're pointing down, but it's acting in a very predictable manner where we have the bottom, top, bottom, top, bottom, top, bottom-ish. Are we now going to advance back up to the top? Are we finally going to break out? Well, we're probably going to have more of earnings actually do well. And that's why it was encouraging to see that Amazon actually got dragged up in sympathy and after hours, because it's also a cloud company, right? AWS is really big. And when we look here to post-market, where is Amazon now? Still up by 1%. Microsoft a little bit less green. Google a little bit less red. So I think cloud is healthy. Why? Hey, Microsoft's just eating Google's lunch. And it's like, hey, thanks, bud. I appreciate it. And we can note that block size of Microsoft is roughly the same as Google and Meta. Why? Microsoft's the second biggest company. It's worth 2.5 trillion. So up by 4, down by 4. That's a net positive if we're looking at SPY. Why? Because of the weightings. All right, popping over to the weekly chart on S&P. I like the bounce off the 50. I like the failed breakdown. I don't like that we're below 427. I don't like that we're only getting a bottoming pattern, not an expansion signal. And we have pretty bearish volume here. We need to see buyers show up. If we look at RSP for a little bit of a different flavor, this excludes the NASDAQ's heavy weighting, or basically a weighted exchange. This is now going to be equal weight. So we can note that we're right back here to the 200 weekly moving average. And this would be an area where I would be expecting to find buyers. Barely a failed breakdown. We're actually up exactly 0 cents on the week, which means we're exactly where we closed out last week. We need to advance from here. We need the average stock to keep advancing. Breadth and depth is needed for a healthy move higher into the end of the year. It's nice to see the 10-year note is down again. So failed breakout back above 5.02. This is largely thanks to Bill Ackman, who tweeted and said that the trading now appears crowded. My neighbor's telling me about it. Time to sell. So he crushed it, right? He just sold all out. Something else which is really notable to me is that we're seeing some progress, maybe even peace. God forbids. Sorry, not God forbid. God, please bring peace to the Middle East. That would be really appreciated. Oil is down by 5% on the week and 2% on the day. That means that maybe we can be hopeful for something to happen there. They're allowing aid to go through. And I think that's a really, really, really good thing. We do still have a bullish pattern on here, or a cup and handle if we're trying to be a little bit objective on it. But down 5% on the week is very constructive, because inflation fears are definitely bubbling up. And this is going to add a little bit of good news to that. What's also going to be really important for this week is that we got a few things. We got earnings after the bell, Bank of Canada rate decision tomorrow. I don't think they're going to do anything. That's what's forecasted too. Jerome Powell speaks, but likely not going to be monetary policy related. He's going to give opening remarks. Then we got the ECB. Then we got GDP. Then we got initial jobless claims. Crap, get out of here. And then we got core PCE coming out on Friday. So that core PCE number is going to be the most important one for me. And the reason why this one's the most important is because the headline's going to be advancing, but the year over year is going to be declining. And I'll tell you the reason why. You might be wondering, hey, well, if we're going from 0.1 to 0.3, how is this number actually coming down? I'll show you right now, because I think this is really important to understand. What's also really important to understand is what the Fed calls sufficiently restrictive. So the Fed says that sufficiently restrictive is taking the current rate of core PCE, which is going to be the year over year headline number, and adding 1.6 or 1.5%. So let's do a little bit of quick math here. And if your brain's going to get a little bit fuzzy, just bear with me. We'll do this for about 2 seconds here. 3.7 plus 1.5 equals what? 5.2. If we make it a 1.6, we add on 0.1 more. Now we're at 5.3. What's the Fed funds rate? 5.3. What does that mean? We're sufficiently restrictive. And we've had the equivalent of more rate hikes by quantitative tightening and by the 10-year Treasury note actually advancing even more. So what's good about this? GDP is higher than inflation. What does that mean? Productivity gains. That's exactly what we want to see. We've been struggling to get productivity gains. Maybe AI is actually helping out. That's how I am reading it. Now we're going to have a look here and see. So we understand that we're probably sufficiently restrictive. And the reason why this matters is because there's an FOMC meeting coming up on November 2nd, the same day Apple reports earnings. But is this one a live meeting? I don't think so. November 1st, sorry. So I don't think anyone's expecting the Fed to hike rates on this date. But what's important is that there's no meeting associated with a summary of economic projections. So please bear with me for roughly the next 2 minutes, and I will explain to you why at the next meeting or December, which there's an asterisk at, and it's a meeting associated with the SEP or summary of economic projections, which means that the Fed needs to justify whether or not they're going to hike more. And I think they're going to get a little bit of good news here. So we're going to look to the month over month number because the year over year takes a trailing 12 month. So right now we're at 3.9 and we tick down from 4.3. How did that happen? Well, if we have a look here, let's actually go to the month over month. So we're going to be including the month of September, and that's going to be coming out right now, which means that we're going to be removing September of last year. So September of last year is a pretty big number here. We note it as 0.5%. So that's like pretty high. That compounds at 6% annually. So then we look at the next month, October, 0.5. And what are those? Those are the highest readings in this trailing 12-month period. So by adding on 0.3, but deleting a 0.5, that's how we go down to 3.7. So let's think about this. If removing one of these 0.5s and going to 0.3 means we remove 0.2, well, what happens when this time next month, before the next Fed meeting in December, that we get the same number? It would come out late November, probably around the time that we're going to get this one here, and we would be removing a 0.5. And if we add anything below that, even a 0.3, this would now reduce to 3.5. So that would be high, lower, high, lower, high, lower, high, lower, high, down to 3.5. We're getting a lot closer to 3, getting a lot closer to 2. And why does this matter? Well, again, one more time, we talked about what is sufficiently restrictive. Well, sufficiently restrictive technically means that we are, let me find that one again here, Fed funds, here we go. So if we're currently at 5.3, and if we go, let's pull up the calculator again, just to make sure this is very clear. So we go here, 5.3 minus 1.5 means we need an inflation rate at or below 3.8% for there to be sufficiently restrictive. That exact word we've been hearing from Fed officials, Christine Lagarde, the Bank of Canada, everybody. Okay, well then what happens if we remove another 0.2 and go to 3.5? Well, that's the same thing as the Fed basically saying now we're sufficiently restrictive and we're actually able to cut by 125 basis points if we want to. I don't think they will. I think they're going to want to keep it where they are and let this number keep coming lower before they ultimately cut. But they would finally have some optionality. They've not had optionality ever since they started this rate hiking cycle. This would be extremely bullish for me. And what that would mean is that we're not going to get a hike in November, and the data should actually support the Fed pausing again in December. And that's when I think the Santa Claus rally can really kick into high gear. So let's make sure we're not getting overly bearish or overly bullish. On the weekend, I talked about how the stage is set, and we're just seeing more evidence on how it's set. We can definitely still go higher. We can definitely still go lower. We're only up by about 0.5% on the week, which means, hey, these bulls got a lot of work to do. Let's not get it twisted. So if that's the case, let's make sure we got our pencils down, and we're very aware of what the market is telling us. So with that said, I encourage you to watch the Weekend Deep Dive now queued up here on the left-hand side. And if you want to subscribe to the channel, I would really, really appreciate that. Look forward to seeing you tomorrow. Thank you again.